We're going to go ahead and get started. The first presentation this morning is the financial forecast, and bless Lorian, she has promised to hurry through that presentation. So we'll get through that, then we'll probably take another quick break, and then we'll jump into the rest of the content for the day. So with that, I will turn it over to Lorian, and I would just please ask Commissioners, if you do have questions, since we do have folks on Zoom, to please continue using your microphones so that folks can hear you and presenters don't have to repeat questions.
Well, good morning. So on the financial forecast, the first 8 or 9 slides really are background about how we forecast and why it's so important. But to get to the most important part, the results, I'm just going to touch on a couple of what I think are the most important slides here. And the first is the difference between the forecast and the budget. And today we're focusing on the forecast, and it's a planning tool. It projects actual expenditures and revenues. It's based on best available information and reasonable assumptions, while the budget is the maximum spending limit in a given fund for 1 year. For example, the 2020 revised budget was $577.5 million. Our actual expenditures were $481.7 million, so we had $95.8 million in unspent authority. And this is, I think, the other most important in this section. And this illustrates why it's so important and why we take it so seriously. So in February of 2011, this is what the commissioners saw at the workshop. In the years of the forecast, we were planning to fall below our minimum balance requirements, and we thought we'd be insolvent within about 5 years. So the commission took action with mid-year cuts in 2011, across-the-board cuts in 2012, and prioritized cuts in 2013. They cut about $20 million out of the operating budget, along with 175 FTEs. And without the warning from the forecast, we wouldn't have been able to proactively address that, and that's why we take the forecast so seriously. So the next couple slides really just talk about how we forecast and some of the influences. So I'm going to go ahead and go to Lindsay's slide so she could talk to you about the key statistics.
Okay, thank you, Lorian. So you all saw this document yesterday. Hopefully everyone still has their copy handy. If not, we do have some spare copies over here. So if you need one, raise your hand and I'll bring it to you. Thank you. So again, just to reiterate what we talked about yesterday. So what this table is designed to show you is information relative to the county's experience since the Great Recession. And so Lorian just told you why the forecast is so important. This shows you the results of that forecast. And so just walking through this sheet then, can you guys hear me if I kind of step over here? Okay. So if you look at this sheet, you can see what assessed value has done over time. So Mark Clark came and spoke with you earlier this week about what it is that we're seeing in our market now. This reflects what really happened. Now, historically, and Lorian will show this in some of the data, we were growing around 5.5% per year in assessed value growth. You can see that that absolutely has not occurred in any time in the recent years, though we were starting to get a little bit closer to those more historic norms the last few years. Lorian will get into what we expect in future years, but certainly we expect COVID to have its impact. But I think a really telling point on this chart is the fact that assessed value went up 26.4%. But if you look at line 4, which shows you the property tax levy itself, so that is how much money the commission has actually requested from its taxpayers each year, that amount is at 18.5%. So while the tax base has grown 26%, the commission has not fully taken advantage of that fact. In fact, it has not done that. And the reason I bring that up is because a lot of what you've heard about the property tax discussion this year, especially at the state level, is this concept of growth and tax increases. And when you look at this, this illustrates that Sedgwick County has not done what it has been accused of. You can see the mill levy rate over those years. Now, I will point out that in 2008, the reason it was higher is because the commission had adopted an intentional mill levy rate increase to fund an expansion to the county jail, and this facility as well. And then the jail didn't happen, and so that mill levy rate was incrementally reduced over the next few years to get it back to where it was without that. So then you can also see, I think, a really interesting point. Line 6 is CPI. That's inflation. So inflation has gone up 22%, and your tax levy has remained below that, even though we know that our costs of doing business go up significantly each year, and that's illustrated later on this table. Your population has only gone up 6%, but still, the assessed value of the community has grown. And then personal income. This one really blew my mind. I did not expect to see this. Personal income in our community since 2008 has grown 33%. When you contrast that with assessed value, when you contrast that with the tax levy, I think it shows that Sedgwick County commissioners have been quite responsible, actually, in how finances have been handled. So then we shift down to the county property tax supported funds. So this is going to be something we'll talk about over time. We are interested in trying to reduce the number of property tax supported funds that we have, because right now we have 8. So these 8 together are captured in this section of the table. So when you look at that, you can see total expenses, and you can see that basically they've remained relatively flat. There were some increases in kind of the middle there, but you would certainly expect that after living under recession-type climate and budget cuts, that those would start to grow a bit. You can see the story with adopted FTEs, how those have only grown 1% in that same time frame, and services have still been delivered to our community. Then you can see the average employee salary. And so Sheena talked about this with compensation yesterday. But our average employee salary has increased about 18%. And I want to contrast that with CPI, because our employees, their rate of pay has not kept up with inflation. And so to me, just from a financial perspective, let alone the studies and comparisons against peers, I think that's a telling statistic for what we're expecting our employees to deal with. At the same time, health insurance costs have gone up 74%. And in this time, there have been a number of actions that the commission has taken to try and mitigate those costs. We went to a self-funded plan, I think back in 2015. Then 2 years ago, with the 2020 budget, we implemented the 3 different health plans, including an HSA plan. So there have been a number of actions that have limited that growth, but still, that's pretty astronomical. That's a cost that's not only picked up by the county, but that's a share that the employee also has to pick up. So that's some out of pocket for them as well. Pension costs. This one also really gets to me because we know that KPERS and KPMF rates are set by the state. That's not anything we have control over. And so you can see those rates, the costs associated with those rates, have gone up 91%. 91 since that time. And those are expenses that, of course, aren't funded. That's something that taxpayers have to fund because these are costs out of the property tax supported funds. So then you can see utility costs have gone up 25%. I expect we'll see a much higher figure next year based on just what you talked about this morning. You can see elections costs, how those look over time. For the purposes of this discussion, we have not included the CARES HAVA or the CTCL discussion. This is just what was funded out of tax funds. And then sheriff costs continue to increase, the care of inmates, medical services, and food, and drivers like that. So we also showed this last year because, again, the discussion at the state level continues to focus on county property taxes and limiting an elected body's ability to generate tax. And so I think it's important to understand, and you actually have a handout today that was put at your seats that looks like this. These are all of the services that are mandated by the state. And you can see a history of how much those have cost us and the revenues that have come in from the state over time. So these 2 rows on your big long sheet only try to tell you kind of the bottom line And so I'm going to refer back to this long sheet, and you can dig into the details if you'd like at some point. But expenditures on state mandated services have gone up 1%. So, okay, we've continued to deliver those services. But look at what the state revenues have done in that same time. They've decreased over 20%. And so these are now costs, again, that the county is expected to pick up, services the county is expected to provide, and that doesn't come cheap. So then we look at other state actions. And this is actually on the bottom of your second page and the top of your third page on that other smaller handout we were just looking at. And so you can see the state had imposed something called a local ad valorem tax reduction. And basically that funding came in and tried to help communities offset their property tax by giving some of that revenue. And this sheet here describes what that is. It was 3.63% of the state's retail sales and use tax. That got discontinued. And so we haven't seen that revenue in some time. City-county revenue sharing, same type of deal. And then, of course, not necessarily arguing with whether this was a good decision or a bad decision, but the commercial machinery and equipment personal property that Mark Clark had talked with you about, that got exempted. And, of course, there was no backfill for that. And so you can see the revenue losses from that have been significant. So looking at this long sheet, you can see since 2008, we haven't received $55.9 million in LAVTR funding, even though it's still on the statute books, it's just not funded. $35 million for city-county revenue sharing, $44 million for the commercial machinery and equipment. And then in 2014, starting in 2015, the state changed its the way we are able to collect mortgage registration fees. And so basically it used to be that for every dollar of a mortgage that was filed, there was a 0.26% charge on that. Over time, that decreased to 0, so it went down by 0.05 each year. And they replaced that with per page fees. Now what you'll see in 2020 is that we got our bacon saved because of the mortgage refinancings. And so we actually received quite a bit more money in that year. Otherwise, we would expect it to look a lot more like 2019. So we expect that to be kind of the new normal, the $4.3 million per year. You can see historically that ranged anywhere from $6.3 million up to $8 million per year. So these are some actions where the state has come in and taken away some of the control, taken away some of the revenue opportunities, but not taken away any of the service demands that we're expected to provide. And so I think this is an absolutely amazing sheet to tell a really good success story about how our citizens here are still getting really good services. Their taxes have stayed below what you might expect, even taking into account just normal things like inflation. And then when you look at price of government, and I will talk with Tom about getting on a staff meeting agenda to go into this in some more detail about what this actually computes. But basically it takes how much revenue your government is getting relative to the basically revenue situation of your community. It's the line 8, personal income. And so it basically puts that into, as we were just talking about, cents per dollar. And so people are paying less than a cent per dollar. And there's a book called Price of Government that came out that set this standard. And basically what happens is when that gets too low, that means that people are probably, it's correlated with people being dissatisfied because they're not getting enough service. If it gets too high, there's dissatisfaction from citizens because they're paying too much for services. We are actually at 0.85 below the standard of 1.0, which is where that correlation happens. So the fact, again, that you haven't heard as much from your citizens at budget hearings about a dissatisfaction in the level of service they're receiving is pretty remarkable too. So I just think this is a really good way to look at our situation, but challenges are ahead, and so we'll let Lorian come back up here and talk about that part. But I guess any questions I can answer at the moment, knowing that you'll have another swipe at me at a staff meeting. Okay.
So as we get into the current forecasted operating results, I want to highlight that what we're going to talk about today is not a recommendation. This is just what the forecast looks like right now, and we haven't done anything yet to try to fix it. Through the budget development process, we'll find out your priorities and the needs of the organization to craft that recommended budget that will be presented in July. And just to note that the current recommended budget date does comply with the potential new property tax and budget bill. Today we're talking about the 8 county property tax supported funds, which you can see in this chart along with their 2021 budget. So department impact is felt in 6 of these funds: the general fund, ComCare, EMS, aging, highways, and noxious weeds. WSU and bond and interest are fairly constant and predictable within a year, and not much can influence them. Each of these funds also has its own target fund balance that we try to reach by the end of the forecast, and the total mill levy for the county is spread across these funds, and it fluctuates each year depending on the needs in the fund and trying to reach that fund balance level, except for WSU, which is always 1.5 mills. And as Lindsay mentioned, we are looking at the possibility of potentially combining some of these funds, and we'll come back to you at a later date with a plan. So you do have an updated version of the long sheet handout. It details the forecast. I'm just going to talk through how it's set up since we'll get into the details in the presentation. So the top section, rows 1 through 34, focus on assumptions for revenues and expenses. The middle section, starting on row 35, shows our operating income and deficit by fund, or how our revenues compare to our expenditures. So if you're taking that into account, if you go to row 44, you can see that what that does to the fund balance by fund for our county property tax funds. And below that on row 54 is the mill levy rate by fund. And finally, we are working off the 2021 to 2025 adopted CIP, which starts on row 63. So in terms of what is actually included in the forecast, we do plan for all current services. The current adopted CIP is included with a $2 million placeholder in 2026. For additional use of the general fund cash throughout the forecast, we have $14.6 million for COVID-19 response in 2021. We have the last 3 years of the radio replacement plan for $2 million. We have the final year of Phase 1 zoo funding for $2 million. $19.5 million is included for technology review board projects throughout all years of the forecast. And in 2022, we do have an additional pay period, which will be a $5 million increase in personnel that year. And for that $14.6 million for COVID-19 costs, these estimates are based on our estimates from departments for their COVID-related expenses through June. Of course, we will keep an eye on this and update it as we see what actually happens. But on this slide, you can see the breakdown by category of what's currently in the forecast. This amount includes things like temporary positions for the health department, testing and vaccination costs, electrostatic spraying by facilities, funding for communications for messaging on testing and vaccinations, and PPE costs. As for what's not included in the forecast, we don't have any additional funding for new programs or unbudgeted community and economic development requests or road projects. We don't know at this time what costs associated with the Odyssey implementation might come up, any unanticipated technology needs, and the match for the North Junction. For our key revenue assumptions, for assessed value, our actual increase in 2021 was 4.6%. You can see that there is quite a large drop down to 1.9% in 2022, and then it slowly starts to increase in the outer years. And thank you to Mark Clark for his help on this estimate. I think he is on Zoom right now, and we'll continue to work with him throughout the process to update these. We have incorporated the mill levy rate resolution that reduces the mill levy rate from 29.359 mills in 2022 to 28.758 mills in 2023. For sales and use tax and motor vehicle tax, they are relatively flat in 2021 to account for the effects of COVID and the 737 MAX. Excuse me. Medical charges for service have seen increases since outsourcing in 2019. And for MABCD and gaming revenues, these were lower in 2020. This was some of the areas where we did see the effects of COVID. However, we do anticipate that these will return to more normal levels in 2021 through 2022. So on the expenditure side, Sure.
Remind me again, that second bullet. We're required to drop the mill levy? in
Yes,
2023?
we have a resolution in place that reduces the mill levy rate down to 28.758 mils in 2023. Lindsay's going to talk about that as part of the debt policy in the next section. And you'll see in a little bit later slides how that affects the forecast. So on the expenditure side, as you've heard about yesterday, there's been a lot of focus on compensation. We know that we were 14% behind market on average 2 years ago. We know that it's a long-term fix, and of course there was no pay pool in 2021. So to keep up with that currently, there are 4% pay pools in every year of the forecast starting in 2022. For health insurance, we have increases of 5% in the outer years. We do know that KPERS and KPNF rates are going to rise, and of course utilities also continue to rise. For admin charges, they're still at the 2021 adopted level, but we think these will increase as well. For software and hardware maintenance, these will fluctuate throughout the forecast more than what you've seen in the past based on what TRB projects are included in those years. And finally, for debt service, what's included is based on the 2021 adopted CIP, and we'll also update that throughout the process. So the bottom line, what that means for us, here's a comparison of our revenues to expenditures. Our blue line is expenses and the red line is revenues. On the bottom of all of these charts, just a reminder that this is not a recommendation, because here you're going to start to see those deficits, and I know that can look concerning, but just want to make sure that you know we have not done anything to fix the forecast at this time. So it's nowhere near the disparity we saw in 2011 from that earlier slide, where we thought we would be insolvent, but there are currently operating deficits in every year. And here we can see the surpluses or deficits, what they look like per year. In 2020, that large surplus is mainly due to the reimbursement of CARES funding for those eligible personnel expenditures. And there are a variety of factors that drive the deficits in the other years. We'll talk about the general fund next, but in the other county property tax funds, those deficits are due to strategic drawdowns to reach those targeted fund balance levels. So the general fund, we do have a minimum fund balance policy. The unrestricted fund balance must be equal to at least 20% of budgeted expenditures and transfers out in the general fund. You can see in this chart that at the beginning of the year, the unrestricted fund balance was 36.4%, or almost $37 million above that minimum level. Now this percent does look higher than what we're used to seeing, and that's due to those CARES funds reimbursements, but that will get spent down during the year on that COVID response. And here's what we expect the ending fund balance for the general fund to look like. The black line that you see in this chart is the minimum fund balance requirement. And as you can see, in 2026, we are projected to fall below that minimum. So now we'll take a look at some of the key drivers for the general fund by year. In 2021, there's a $14.9 million deficit. This includes $14.6 million for COVID response, the final year of Phase 1 zoo funding. We do have $1 million in TRB projects included, the third year of radio replacement for $0.9 million, and $1.4 million of CIP projects. In 2022, there's a $5.9 million deficit. This is where we have that additional 27th pay period, which is $5 million in the general fund alone. We also have the 4% pay pool, which adds $3.6 million for compounding costs each year. We have $4.8 million in TRB projects. There's the fourth year of radio replacement for $0.6 million and $1.4 million for CIP projects. 2020,
Maureen,
yes.
So in 2022, if we just don't pay that 27th pay period, then we're break even? Oh, really?
That would also save us costs. So in 2023, we have a $7 million deficit. This is the first year of the reduced mill levy rate, and that is a revenue loss of about $3.4 million per year. There's the 4% pay pool. There's the final year of radio replacement for $500,000. We have $2.5 million for CIP projects and $4.5 million in TRB projects. In 2024, we have a $5.7 million deficit. And on each of these last 3 years, you will see that mill levy rate reduction for that revenue reduction along with that 4% pay pool. There's also $2.8 million in TRB projects and $1.5 million in CIP projects. In 2025, we have a $10.8 million deficit. This includes $3.6 million of TRB and $2.8 million of CIP projects. And then finally, in 2026, it's a $9.5 million deficit, which includes $2.8 million in TRB and then $2 million for unspecified CIP projects. So here are the aggregate fund balances for all county property tax funds on a budgetary basis. We anticipate that we will end 2026 with $49.6 million in fund balance. Again, this is just a starting point. It's not a recommendation. Throughout the process, we'll find out your priorities and the needs of the organization, and then we'll work on the forecast and that recommended budget. So today's presentation is just the beginning. Base budgets will be released to departments next Tuesday, and their submissions and any requests for additional funding are due in late March. Our county manager reviews will be in late April. We have commission hearings in mid-May. July 14th is the manager's recommended budget presentation and the last up day. For our 2 public hearings, the first is July 21st at 9 a.m. The second is August 2nd at 6 p.m., and budget adoption is scheduled for August 4th. And also to note that past that recommended budget date, this calendar does not comply with a potential new property tax and budget bill. So with that, I'd be happy to try to answer any questions you might have.
Thank you, Chairman. Just maybe more of a comment and a reminder to everyone in the room. I think we ought, and I've talked with Lindsay about this in the past, I think we ought to ask for legislation that would allow us to put money into the TRB fund and then roll that over from year to year. One of the things I see on here is the volatility of that spending. It goes from $1 million to 4.8 to 4.5 to 2.8 to 3.6 to 2.8 million over those 6 years, and I think that's too volatile. But if we had the legislation that would allow us to essentially peanut butter that fund, we could put money in there each year and then roll over the unused funds from year to year. But this requires legislation. So in terms of trying to help manage our budget, to me this is reasonable, good legislation. We need to ask for permission to do this. So I'd like to just throw that out there on our legislative platform, a way to help us with our budgeting. It would help us not have such volatility. Thank you.
Is that something that we could, I don't disagree with you. I guess I just would like some more information about that. So is that something that we could look at potentially doing a workshop over? Because I added it up actually, and it was $19.5 million over 6 years. And so in addition to that, can you guys send out a list of those projects because
Yeah,
it's
absolutely. I'll
probably
send that out to
buried
you.
deep in my inbox. That would be nice. Thank you so much.
And I will just note that those TRB projects includes the new projects and the recurrent cost. So it's the total cost for TRB. But I will send that out to you.
Okay, I don't see any other questions at this time. Thanks, Lorian. You always do a good job. Appreciate it.
Thank you.